Something just happened in the global financial system, and almost nobody is talking about it. Not because it's small, but because if people truly understood what it means, panic would spread overnight. For decades, the world economy rested on a silent agreement, a fragile balance that allowed the United States to spend beyond its limits, kept interest rates artificially low, and supported the lifestyle millions came to see as normal. But that balance may have just been shattered. Behind closed doors, central banks are repositioning. Institutional money is moving, and one of the largest creditors on earth appears to be changing strategy. The question is no longer if the financial system will change. The question is, are you positioned before everyone else realizes it? Because by the time headlines confirm it, the opportunity window will already be gone. Stay with me, because what I'm about to explain could redefine how you think about money forever. To understand why this matters, you need to understand how the system worked for the last 40 years. It was almost the perfect economic loop. The United States consumed, Asia produced, dollars flowed overseas, and instead of converting those dollars into local currencies, which would strengthen them, many foreign governments recycled that money straight back into U.S. debt. Treasury bonds became the backbone of global finance. This arrangement allowed America to run enormous deficits without immediate consequences. It helped suppress borrowing costs, supported housing markets, inflated asset prices, and most importantly, created the illusion that debt didn't really matter. But every system built on confidence has a breaking point. And when major buyers begin stepping back from government debt, markets notice. Slowly at first, then suddenly. Here's the part most people miss. Government bond markets are not just another investment class. They are the foundation upon which nearly all financial assets are priced. Mortgages, corporate loans, stock valuations, derivatives. Everything begins with the so-called risk-free rate. So when demand for sovereign debt weakens, the consequences ripple through the entire economy. And those ripples can quickly become shockwaves. But the real danger isn't just higher rates. It's what governments are forced to do when financing becomes harder, and it may directly affect your purchasing power. Modern economies depend on continuous refinancing. Old debt gets replaced by new debt year after year, but this only works smoothly when buyers remain confident. If confidence fades, governments face two painful choices. Option 1. Allow interest rates to rise enough to attract private capital. Sounds reasonable until you consider the math. Higher rates dramatically increase the cost of servicing national debt. At extreme levels, interest payments alone can begin consuming a massive share of tax revenue. History shows that when this dynamic accelerates, policymakers enter dangerous territory. Option 2. Central banks step in. They purchase debt, inject liquidity, and expand the money supply. This stabilizes markets in the short term, but risks igniting long-term inflation. And inflation is not just an economic statistic. It is a silent transfer of wealth, from savers to borrowers, from cash holders to asset owners, from the unprepared to the positioned. Now here's the uncomfortable question: if forced to choose between austerity and currency dilution, which path do governments usually take? If history is any guide, the answer is rarely popular, but highly predictable. And what's happening right now suggests that policymakers may soon face exactly that dilemma. But the next domino is even more concerning because it doesn't start in government. It starts in housing. Housing markets are extraordinarily sensitive to interest rates. Even small increases can dramatically change affordability. Imagine a typical home buyer. At low mortgage rates, monthly payments remain manageable. But as rates climb, payments can surge, sometimes by thousands per year. This doesn't just cool demand, it freezes it. Potential buyers hesitate, sellers hold off. Transaction volume falls, liquidity dries up, and when liquidity disappears, prices can become far more volatile. Now think about the broader implications. Housing is the primary store of wealth for much of the middle class. When property markets weaken, consumer confidence often follows. Spending slows. Economic momentum fades, but housing is only one layer of the system, because beneath it sits something even more interconnected: the banking sector. What many people don't realize is that banks are deeply exposed to interest rate movements. During long periods of low rates, financial institutions often accumulate large portfolios of fixed income assets. On paper, these holdings appear safe, but when rates rise, the market value of older bonds declines. Usually this isn't a problem, unless liquidity is needed quickly. The real risk emerges when confidence wavers, because banking is built on a simple premise. Not everyone withdraws at the same time. Digital finance has changed the speed of this equation. Funds can move in seconds. Rumors travel even faster. That's why central banks closely monitor liquidity conditions. Their goal is simple: prevent temporary stress from becoming systemic fear. But here's what should capture your attention. Whenever institutions quietly strengthen balance sheets, increase reserves, or adjust lending standards, they are preparing. Not predicting. Preparing. And preparation often happens before the public understands why. Which brings us to the most important shift underway, one happening far beyond traditional banks. Central banks themselves are changing behavior. Around the world, monetary authorities have been reassessing reserves. Diversification has become a recurring theme. Why? Because resilience matters in uncertain environments. Some institutions are increasing allocations to tangible assets, others are reducing concentration risk. This isn't panic, it's strategy. And historically, when long-term players reposition quietly, they're not reacting to headlines. They're anticipating future conditions. So the real question becomes, what should individuals learn from this? Not fear, not speculation, but awareness. Because financial transitions rarely announce themselves in advance. They unfold gradually, then appear obvious in hindsight. And the next phase of this transition could determine who preserves wealth and who watches it erode. Let's talk about protection. There's a pattern that repeats across monetary history. When uncertainty rises, capital tends to migrate towards scarcity. Assets that cannot be easily created, assets with intrinsic demand, assets perceived as stores of value. This doesn't mean abandoning markets, it means thinking in layers of resilience. Ask yourself, if inflation accelerates, if borrowing costs remain elevated, if currencies fluctuate, is your strategy adaptable or dependent on a single outcome? Sophisticated investors rarely rely on one scenario, they build optionality. Flexibility is a financial superpower, and perhaps the greatest risk today isn't volatility, it's complacency, because the majority only reacts after change becomes undeniable. By then, pricing has already adjusted, opportunities shrink, and repositioning becomes expensive. But there is one mindset shift that separates those who navigate transitions successfully from those blindsided by them: ownership. Understanding where and how your wealth is held matters. Counterparty risk is often invisible during stable periods, yet it becomes crucial during stress. Diversification isn't just about asset classes. It's about structure, liquidity access, jurisdictional exposure, and time horizon. None of this requires dramatic moves. Often it simply requires intentional planning. Because the goal isn't to predict catastrophe. The goal is to remain robust across multiple futures. And remember, wealth rarely disappears overnight. More often, it transfers. From reactive participants to prepared ones, from leveraged positions to resilient balance sheets, from short-term thinking to long-term strategy. Right now, the global economy isn't collapsing, but it is evolving. Debt levels are higher, geopolitics more complex, financial linkages tighter than ever. Transitions like this redefine winners and losers, and the biggest mistake you could make is assuming the next decade will behave like the last. So don't focus on fear, focus on positioning. Don't wait for certainty. By the time certainty arrives, markets will already reflect it. The individuals who protect and grow wealth are rarely the fastest, but they are often the earliest to adapt. If you want clear, rational breakdowns of the forces shaping the global economy and strategies designed for the real world, not financial fantasy, then subscribe to Economy Central. Because in times of transition, information is leverage. And the better you understand the system, the harder it becomes for the system to surprise you. The shift is already underway. The only remaining question is, will you recognize it early or read about it after everyone else does? I'll see you in the next video.